Hi, my name is Jared. I'm the owner of SMB Bookkeeping, a small bookkeeping and tax firm based in Orlando, Florida. And I wanted to make a video today for amortization schedules. I feel like it's a good topic to review and a helpful item to provide. So I'm here on the QuickBooks test drive account. So I find a lot of people aren't familiar with the test drive account. It's basically a free version of the software anyone's able to access. I've just typed right into Google QuickBooks Online Test Drive. Here's the account. I'm just going to click on that first link. It is recommended to visit the test drive account in an incognito or private browser window, just so it doesn't try to sign you into the browser doesn't try to sign someone into their live QuickBooks Online account. So I'm just going to click that first link to visit the standard version of QuickBooks Online, the test drive account. And it'll have a security verification. Always good to check those. And then while that loads, I also have a copy of my amortization schedule that I use. I'll include a copy of this amortization schedule down in the description of the video, below the video in the description. I'll include a link there. Also, you can always DM me directly, send an email, and I'll send over a copy. This is my my document that I use. I use this loan amortization schedule for previous loans, mortgage. When I have businesses that I work with and they purchase vehicles, food trucks, this is the live amortization schedule that I have. It's all set up, ready to go. And I wanted to talk about some of the important items in an amortization schedule. First is the interest rate, fairly self-explanatory. The number of years, the payments per year, typically 12. In the amount. Most importantly, the payments per year, and the amount's going to be the principal, and the payments per year. Each of those periods we'll see is going to have a separate amortization calculation. So once I enter a principal there, it's going to fill out the amortization schedule, and we'll see each of the columns for row 7. Includes all of the calculations already entered into the amortization schedule. So it's a really simple enter and use, good to go amortization schedule. So amortization schedules in and of themselves are fairly straightforward and simple. Again, we're going to have the interest rate. We'll have the number of years, payments per year or our periods, and a total principal balance. So what we'll see is here down in column 7, row 7, each column has the calculations already included in the amortization schedule that I'll include, and I'll include a link below. And I'll include a link below. So what we'll find is each of the cells in row 7 for each column will include the calculations, and I'll include a link below to the Excel in a Google Drive, just so anyone can access that and be able to make use of it if it's helpful. Amortization schedules are not overly complicated, fairly straightforward. We just the main item to point out for the amortization schedule is that we'll have individual independent periods. For each of those periods, we're going to have a calculation. It's going to be the interest rate multiplied by the principal. In the payment, there will be a principal portion and a principal portion. Those two will be combined to equal the total payment. I'm just going to bring up a calculator here really briefly just to add those up to tie those out. And 95 plus 694 and 79. So 1749.75. And the principal portion from the prior period is going to reduce the total principal in the next period, so that when the calculation is completed, even though the interest rate doesn't change, we'll see the principal and interest allocation change each period. Typically on a 30-year mortgage, around year 12 or 15 is where we'll see the change, where we'll be paying more principal each period and less interest. So typically, in the first 5 to 7 years of a mortgage, for example, we're paying much higher interest, and around 12 to 15 years, we'll see that change. And then in the last part of the loan, we'll be paying more principal than interest. That's because for mortgages, for example, the average life of a mortgage is 5 to 7 years, if I remember correctly. So that allows the financial institutions to maximize profits, which is always good for financial institutions. Here in the amortization schedule, we'll see it's also the same technical process for a bond amortization schedule. So for example, a bond amortization schedule typically is simply a coupon of $1,000. Nearly all bonds are $1,000 coupon. And typically the bonds are much shorter timeline, 30, 60, 90, 120 days, 2 years to 10 years on the longer side of bonds. And certainly a topic I have interest in making subsequent videos about, municipal bonds as well as federal bonds and the bond amortizations and the mechanics. However, for this video today, simply a standard amortization schedule for a mortgage, or what's known as a note payable long-term debt, is going to be the best example. So we'll go back to that 115,000. We've reviewed the periods and how the calculations are updated essentially for each period. And what we'll find is at the end of the year, we'll have a total here. Total here for, auto summation. We'll have a total here for interest for the 12 months. And we'll have a total here for principal for the 12 months. And what we'll find in this video as well, I intend to make to enter a year-end adjustment, which is what we use the amortization schedules for. And we'll see when the year-end adjustment is made, on the balance sheet, we'll be reducing the principal, that by that amount, the principal that was paid over the 12-month time frame, and we'll have an interest expense on the P&L for that amount when we make the adjustment. I'll go through that adjustment as well. Okay, we've gone through and we've entered our amortization schedule. We've updated it for the principal amount, the payments per year, typically 12, the number of years, and the interest rate. That's going to give us our calculations for the entire life of the loan here for those 7 years. And for each individual year, we're going to total our interest and our principal totals, the amounts, and we're going to tie those out to the books. So here in QuickBooks, Online, I'm going to run a P&L report, and I'm going to run a balance sheet report very quickly. In QuickBooks Online, I'm going to run a report here for a P&L. Let's see, I'm going to run a P&L for, we're in 2025. I'm going to see if it'll let me run a P&L for, let's see what our P&L looks like for 2025 first. Let's do, this year to date. And we'll call it this year to last month. And we'll call it cash, 1/1 to 9/30. Okay, so there's not too many transactions there. So that's okay. That's fairly standard. I'm going to actually see if it will allow me to run a P&L for last year, for the full year, 12/31/24. Very good. Okay, that's even better. Okay, so we'll see the P&L here. There's no amounts on the P&L. I'm going to run a balance sheet as well for 24, and just to see those numbers here in the QuickBooks Online test account. So we'll run this for last year, and we'll change it to cash. Okay, very good. So no information for last year as well. Okay, so now what we're going to do is we're going to go to plus create. We're going to enter a journal entry, and we're going to enter our journal entry as of December 31st of the prior year. Typically, that's the date that we're adjusting for transactions for. So we'll go plus create. We're going to select journal entry. There we go. So I'm going to 12/31/2024. And we're going to have an interest expense. Yep. We're going to have an interest expense. So first, what I'm going to do, actually, now that I'm thinking about it, I'm going to go back and I'm going to record on the 1st of 2024 our note payable. So this is going to be note payable, and we're going to call this loan number 1234. And when we enter a note payable, what we'll do is we'll select for the type of account long-term debt, and let's see, liabilities, long-term liabilities. And that just means that we plan to be making payments for longer than 12 months. If it's not 12 months or longer, it wouldn't be a long-term debt. And we're just going to leave that as create the account. We're going to create the liability. It's going to be $115,000. This is going to be for a new food truck. And we're going to offset it to an equity account. Let's see what we kind of have here for equity. Okay, let's see. So we have opening balance equity. That'll work for now. We'll record that to opening balance equity. Down here in the bottom right, I'm going to click Save and New. So it saves that transaction. It's going to open up a blank window. We're going to update that for the end of the year, 24. Here we're going to have interest expense. Let's say, okay, so we'll add an interest expense. This will just be an ordinary business expense. Expenses. We'll call it other business expenses. Yep, business expense. Save and close. And what we'll do is we'll revisit our amortization schedule, and we'll see our interest expenses 7908.25, 7908.25 to adjust interest expense and principal on note payable. And here we'll do we'll have note payable 1234, and we're going to reduce that by 13,088 and 71. Yep, 13,088 and 71. 13,088 and 71 cents. Okay, so we're going to be so we are going to be reducing the note payable and the interest expense by the amounts that agree to our amortization schedule. We're also actually going to attach, so I would, in this adjustment, I would save my amortization schedule from the cloud to the desktop, and I would upload an attachment here for that amortization schedule to include it with the adjustment. But for here, what we're going to do is we're going to credit the bank account. So we'll just find a checking account here. Let's see. Checking account here. So checking, yep. And a credit is going to reduce the bank account. So that's going to represent the monthly, 12 monthly principal and interest payments that total these amounts. So we'll select save and close for this one, and then we'll quickly rerun the P&L and the balance sheet. So last year, there's a balance sheet there already. So last year balance sheet, yep. 1/1/24, 12/31/24. So we'll see our checking account went down by the payments that were made. And we're going to scroll down here and we'll see our opening balance equity. That's the initial loan. We're going to see that 115,000 reduced by that 13,088, I believe was the amount. 13,088 and 71. So let's see. Just to tie that out. 115,000. 13,088 and 71 cents. 101, 911, and 29. That's going to agree to our balance sheet. And that's how those adjustments are entered after the amortization schedule is updated. And I'm also going to run the report for the profit and loss as well. And we'll see our interest expense on that profit and loss agrees to our amortization schedule. $7,908.25. And again, I'll include that amortization schedule down below the video as a link. And always okay as well to send a direct message or an email, and I'll send that over. This is my my amortization schedule that I use and have used for loans in the past many times. Thank you for watching the video, and I hope you have a nice day.